Jeff Lewis, Executive Director of JPMorgan Asset Management Company, joins us now. Morning, Jeff. Thank you very much for joining us. How would you read yesterday's ECB announcement? What kind of assets do you think are going to receive this big money that comes out of the ECB?
Well, it's going to be a broad range of private and public sector assets. So we will see buying in covered bonds, we'll see encouragement of ABS, and of course we'll see sovereign bond purchases distributed in line with the European Central Bank's capital key, so sovereign QE. So 1.1 trillion beginning in March and carrying through until September 2016. That's a pretty big commitment. So clearly, Magic Mario, he's the man of the moment. He has met expectations, even though those expectations were quite high. The ECB's action is warranted. We were in a situation where inflation expectations at the 5-year level were falling. They needed to take action. And they have done so. So, yes, very good news indeed.
Okay. But still, if you can tell us what would be your, say, top 3 assets that you think will receive this kind of money. Would it be US equities, Indian equities, any kind of fixed income instruments?
Well, when you say receive the money, I mean, the ECB is going to be purchasing European government bonds. The yields are already at record lows, so I don't think those assets are particularly attractive to investors. But what this commitment to unconventional monetary policies from the ECB does, it ensures that 2015 will be a year of ample global liquidity, no credit crunch, even though the US might be raising rates in the second half. That is supportive of risk assets generally and equity markets across the globe, as you say. Year to date, I think the stocks index until yesterday was up about 6%, whilst the S&P was flat. So definitely European equities have been in the lead, and that's quite natural, I think, when the stimulus is taking place in an economy where expectations have been very low. It doesn't take much good news now on the Eurozone economy, I think, to see further outperformance from European equities relative to the S&P 500.
Jeff, hi, morning. We have another big event, the Greek elections on Sunday. What is your expectation from that? And if there is a Grexit, then do you think it could cap the gains that equity markets have made courtesy the ECB policy?
Well, it's in the short term, it's always possible that a few days' gains could be given up by a negative political event somewhere else. In terms of the importance, I would say today's action from the ECB ranks #1 level of importance. The Greek elections much further down the scale. Of course, they're very important to the Greeks. They're very important to the kind of government the Greeks vote for. But even if Syriza, as looks likely, form the next government, Greece is not in a particularly strong bargaining position to rewrite its debt restructuring agreements with the Troika, with the IMF and the ECB, etc. So Greece is not in a strong bargaining position. They could bargain for a slightly better deal, for a change in some of the terms on their agreement. Maybe maturities will be extended. I don't think debt forgiveness is on the table, and I think the EU ECB will take a fairly hard line with Greece.
Okay. Just hold on, Jeff. Only wanted to point out a couple of things that are happening in the market at this point in time. The PSU banks, which started the rally early morning, are now seeing a distinct amount of profit taking, and they are the ones that have probably led the market lower. PNB and Bank of Baroda, in particular, in the Nifty, are both in the red. They started off with about 1.5% in terms of gains. So the profit taking seems to be led by these kind of stocks, but not restricted to them at all. The IT companies, which were anyway the weak link in the market with the appreciating rupee, are also seeing a distinct amount of weakness. Metals are also moving down a bit, and notably NMDC, but not only NMDC. Hindalco has also joined the red brigade, but also slightly. In particular, we must pull out Havels. That company gets a lot of its earnings from Europe, the Sylvania bit, and since the euro gets cheaper, Havels is losing a bit of steam, as you can see. Well, Geoff, what's your attitude to the Indian markets itself? We are seeing it gaining in strength sometimes by the minute, as it were. Do you see it being generally a gainer because of the easier liquidity? What kind of gains do you see at an index level in 2015 from India?
We don't unfortunately give projections of index levels for the Sensex at the end of the year, but I would feel that the ECB's actions, it is helpful to the emerging markets. It removes this threat of a global liquidity crunch in 2015. It strengthens the search for yield, and I think emerging market equities will benefit as well as US and European equities. And I think India has strong fundamentals, so I think we're not going to see a major risk-off episode for the emerging markets, and so that is good news, and money will start to flow again after the outflows we've seen over the last month. I mean, there were outflows in January, and I think India will continue to attract a pretty decent share of the total amount of money going into emerging Asia equity markets from foreign institutional investors.
Okay. In the interactions that you have had with a lot of other institutional investors across the world, Geoff, what is the outlook on India? Because there's been a huge outperformance already. A lot of the reforms are getting priced in even as we speak. Is there still a lot of optimism, and is there fresh money being pumped into the Indian markets?
I think we can see reasonable amounts of money coming in. There's been fresh money going into the Indian government securities market. We've had outflows from emerging Asia in 4 of the last 5 months. But in almost all of those months, in the second half of last year, there were still small net positives into India. So India is in a favoured position because of its strong fundamentals. And I think valuations are no longer cheap, but they're not particularly expensive either, so valuations are not really a strong barrier. Investors are looking for growth. There's still a scarcity of good growth stories, and India stands ahead of the pack in that dimension.
And is there any particular sector or stocks that you like in India, where you would add in incrementally?
I think, well, we've seen a very good run-up in the banks and the financials. I think domestic cyclicals, I think infrastructure, CapEx-related, still have quite a long way to go. So basically domestic bias, consumer discretionary, certainly. All these areas we currently favour.
All right. Sorry.
Okay. If we have time for one more question, I would like to just ask you what your expectation is from the FOMC policy later this month. And if there is any hawkish commentary from the FOMC, will that then sort of overtake the mood in the market or sour the mood in the market at all?
Well, on that latter point, I think the hawks are more in the minority now. I think Yellen and the dovish camp are pretty firmly in control. Don't expect much change in the wording. They changed it last time. They're going to be patient. And they want to make sure that investors get the message. They are data dependent. They are watching the data. So no real major change at the next FOMC.
And to add to their dovishness, inflation, if anything, has moved lower since they made that patient comment. Geoff Lewis, thank you very much for joining us with your comments this morning.